So in this video, I am going to show how one can estimate the time decay associated with an inverse leverage fund. In this case here on the screen, I have the TZA, which is supposed to give in very short time periods 3 times the inverse of the Russell 2000, which is uh, very close to the return given by the IWM ETF. So I'm comparing the TZA with IWM. And to give an idea of the time decay, I'm choosing the period 6 months. So over this period of time, uh, the IWM, which tracks the Russell 2000 small caps, uh, has gone down 15.41%. So had a return of minus 15.41%. Whereas the TZA during the same period went up 31.15%. So three times the inverse of minus 15.41% is actually 46.23%. But due to time decay, the return of the fund was actually, let me correct the number here, 31.51%. So the the return, and I think this is slightly different from the number that I have on the blog post that I put up with a similar um analysis. So, but in any event, the time decay here is 15.08% for the period of 6 months. So about 7 point something percent loss for 3 months and so on. So it's quite a big loss in terms of time decay for this period of time. And in this period, uh, the uh, the TZA has done not so well, but quite well since since about a month ago. So within the last month, it has done quite well. Now, you can do the same analysis for other funds. So let's take, for example, let me remove this and let me change from TZA, let me change to this SQQQ, which is uh, the inverse, ultra shorts inverse of the QQQ. So let me compare with the QQQ, which is the NASDAQ. I could compare this with the NASDAQ, but I will use the QQQ. So over 6 months, I have the QQQ going down by this much, and the SQQQ going up by this much. So let's take a look and see what I would expect. In the ProShares Ultra Short QQQ, uh, I believe is at 3 times as well. So let's see. So the QQQ went down 19.66% according to these numbers. And so that would have been a much higher return, but the return that we ended up getting was 39.77. So this was the time decay for this period. I just want to make sure that this is 3 times because this SQQ is giving a worse performance than the TZA. So let's see if this is the it's if yeah, it is 3 times. It is 3 times the daily performance of the Nasdaq. So in this particular case, the time decay over a period of 6 months was almost 20%, so even worse than the TZA. So you can do these estimations for various funds just to have an idea of how much you would be losing if you held the fund too long. So the bottom line is that these inverse leverage funds, which become very popular in periods where we have a bear market, um, they are not to be held for too long because of this time decay. So they're designed to be held for shorter periods of time. Uh, but on the other hand, for you to predict when to invest in one of those is very difficult because you have to be very good in your timing. Uh, Normally, people would look at the ISR. So let's say for the QQQ. So let me change this for the QQQ, and so let me take a look at this RSI, which is an indicator that tells you when the particular security has been overbought or is overbought or oversold. So typically, when it's it's going toward the lower end of the scale here, which is 20, then you have a potential for a rally, and then obviously that's not a good time to buy an inverse leverage fund. At the good time to buy an inverse leverage fund is when the particular asset is close to the upper end of the RSR, which would be this one here. So in this particular situation, we had it's close to 70. So, but again, this is a difficult decision to make because if you time it wrong, you end up losing money during that period. And if you hold on to your inverse leverage fund investment, you could potentially lose even more due to time decay. So this concludes this short video on of inverse time decays of inverse leverage funds.